The Peter Schiff Show.
Well, I'm recording this podcast early on a Tuesday morning. I just wanted to go over some of the economic data that came out early this week before leaving for Las Vegas later this afternoon. I'm hopping on a plane and heading out there. I've got a couple of events. We've got the SALT Conference, Skybridge Alternative Asset Conference. I am on a panel Thursday morning. Should be very interesting, lively discussion. One of the guys I think that's on there with me is I'm blanking on the guy's name now, but he was in the Obama administration. He was an economic advisor. I did a debate with him. Gene Sperling is on the panel. So he's the one guy that I think I'll have the most disagreement with. Steve Forbes is the moderator of the panel. And we've got some other interesting participants. So that's going on coming up. Then I'm going to be stopping on Friday in Salt Lake City. I have a one-day event there. If you're not, if you live in the Salt Lake area and you haven't signed up, you can sign up to come see me on the Europac website, europac.net. Then I'm going to be in LA for a few days and back in Las Vegas for the Money Show. And if you live in the Vegas area, or even if you don't and you want to come to Las Vegas, you should come and hear me speak at the Las Vegas Money Show. We will be out there. We will have a booth. Some of the Europe Pacific Capital brokers will be out there, an opportunity to meet your broker if the broker you work with is there, or meet some of the brokers, or maybe if you're just going to be opening up a brand new account with Euro Pacific, you can do so at the Money Show and do it with one of the brokers who is working with me at the booth. I will be doing a workshop, among other things. You can check the schedule for my speaking appearances. Of course, I will be at the booth much of the time, so we'll be happy to talk to clients and prospects alike while I am there. I'm going to be away from my office here in Connecticut for approximately 10 days, so a pretty big trip for me. Let me get to the news of the week. Most of it, of course, was bad. Yesterday, we got factory orders, and they were for March. So this is, part of Q3, and factory orders did manage to meet expectations for a rise of 2.1%. But here's the catch. They downwardly revised the February number. And as a result of that, and that was to a negative number from a positive. And so even though it was up as much as they expected, since it rose from a lower level, the absolute number was still weaker than expected. In fact, this is the fifth straight year-over-year monthly drop. So in other words, March 2014, March 2015, you have a drop in factory orders. We've had that year-over-year monthly decline now for 5 consecutive months. So again, this number will probably take a little bit off of the first quarter GDP, which is barely hanging on to positive territory. But the big news that is going to really shatter an already weak first quarter is the March trade deficit, where analysts were looking for about 40 billion, 41 billion. It was going to be a widening from a relatively low number that we had in February. February's trade deficit was only 35.9 billion. And that was a little bit higher than the original estimate of 35.4 billion, but it was still one of the narrowest monthly trade deficits we had in a while. Part of that might have been related to the port strike, although now they're trying to say that the big surge in the trade deficit in March was related to the port strike. And so, I don't know, does the port strike make your trade deficit go up or down? Well, if you average the 2 months, it's still horrific. But the number we got for March, 51.4 billion, was almost 10 billion higher than expected. And in fact, when you add in the downward revision to February, the miss was greater than 10 billion. Now, this is going to subtract significantly from fourth quarter GDP. So certainly fourth quarter GDP, when they revise it the first time, is not going to start with a positive number. It's going to be a negative number. And of course, if they have a revision to the deflator, and you remember, this is the first deflator we've had since 2008, which was the first deflator we've had since 1949, that was actually a negative number, which means it really wasn't a deflator, it was an inflator. because we actually increased the nominal GDP because the government told us that the cost of living actually went down during the first quarter. Now, that's not going to be the case during the second quarter, and I will get to that momentarily. But let me just get back to this trade deficit number, this $51.4 billion. To put this number in perspective as far as how awful it was the single worst trade deficit since October 2008. So you got to go all the way back to the beginning of the financial crisis to get a trade deficit as large as the one we just got. But also, if you want to think about it in percentage terms, how much worse the March number was from February, it is the largest monthly gain or percentage gain since 1996. So what is that, almost 20 years to find a month where the trade deficit worsened by the same percentage it did this time. And in fact, if you exclude crude oil, the March trade deficit was the widest in history ever. Biggest trade deficit we've ever had. Now, if the economy is really so good, why do we have the worst trade deficit ever, right? It's like a corporation with the biggest loss, right? The CEO is out there talking about how great the company is doing, and they're losing more money than ever before. Because the trade deficit, your balance of trade is like a corporate P&L, right? We're losing money. We spend more on the things we buy than we make on the things that we sell, right? We're operating at a deficit. So a horrible, horrible number. But think about this. Oil prices were very low in the first quarter. And certainly they were low in March. They have started to surge. Oil prices have been headed higher almost every day. In fact, as I speak, we're up just shy of $2 a barrel. We've been up more than $2 a barrel. We're almost at $61 a barrel. This is the first time crude oil has even been above 60 in 2015, but we've been trending higher, and we certainly can go higher still, which means that the benefit that the trade numbers had from the cheaper imported oil, that's going to go away, because now that oil is going to become increasingly more expensive to import. And of course, domestic production has come way down since the price of oil has come down. The rig count has collapsed. And so we're going to need more of that more expensive oil. And so that trade deficit is going to go up. But also think about the depressing effect that it's going to have on consumer spending. There are a lot of people who lament the fact that the consumer didn't benefit from the cheap oil prices. And everybody was saying, hey, this is going to be a boom. We're going to have all this spending, right? Because gas prices are cheaper. Consumers are going to pocket that windfall and then spend it at the mall, right? And everybody was looking for that to happen in the first quarter. And it didn't happen. And so now people are still waiting for it to happen in the second quarter. Maybe there's some kind of delay. It's taking longer for consumers to realize that, this is a real windfall, that this is a permanent gain because oil prices are going to stay down forever, right? This is what we were told. Well, I actually think that the consumer did benefit from cheap gas prices in the first quarter. It's just that he was in such bad shape from everything else that it was hard to see the benefit. Because it's just that the consumer would have been that much weaker had he not had that crutch, had he not been able to fall back on the cheap gas prices. Well, my point has been that crutch is being taken away. So what's going to happen is, while we didn't see the positive impact of lower oil prices because it was obscured beneath all the other bad things, we are going to see the negative impact as oil prices rise back up, because it's just going to compound the problem where the cost of everything else is going up. Things like rents. I looked at a statistic over the weekend. I read a couple of articles on rents, and rents have been rising so rapidly that the percentage of renters now that have to devote 50% of their income to housing, which is basically rent and utilities, is at the highest level ever. It's like 25%. It's up significantly from where that was in 2007. So rising rents have been squeezing more and more Americans who have been priced out of the housing market. But of course, homeowners have been benefiting from the cheap interest rates. But Treasury yields have been rising. They're at the highest levels of the year. They've gone through the 2% level. Now what are they at, 215, 218, something like that. Mortgage rates are also rising to their highest level for the year. So now you've got trouble on the horizon for the homeowner, too. If you've got an adjustable rate mortgage or people who are thinking about buying a house, the cost of doing that is going to go up. So it's not just rents that have been going up. And they've been rising something like, 3.5%, 4% a year, much, much higher than the official rate of inflation. But we got rising oil prices, we got rising interest rates, we got rising mortgage costs. And of course, if interest rates are going to go up, you're going to see auto loans, cost of auto loans and credit card debt. And by the way, I forgot to mention this on the podcast for Friday. I totally forgot about this data point, but I did end up including it in the comment section. April U.S. auto sales fell, missing expectations for the 5th month in a row. And in fact, sales are now at their lowest year-over-year start for the year. So meaning January, February, March, April, those first 4 months. This is the weakest start of a year for the first 4 months since 2009. Now, what was happening in 2009? We were in a recession. So when it comes to auto sales, 2015 is the weakest year since the recession, the Great Recession of 2009. And what is that telling you? That the auto bubble has burst. And the auto bubble was part of what had been powering GDP, all these people buying cars they couldn't afford with cheap government loans. Well, now interest rates are starting to rise, which means that those cheap loans are not going to be as cheap. So the bloom is rapidly coming off this recovery rose. The dollar is reacting, I guess, negatively. I mean, it's down on the day across the board. It could be down more. I mean, especially with such a horrific trade deficit. You know, back in the day when people actually cared about trade deficits, a day like this, the dollar would be getting crushed. I mean, it'd be actually getting obliterated because a huge trade deficit is very negative for your currency because it means you're flooding the world with a currency that it doesn't want. Right? I mean, we're buying all these goods and we're not exporting goods to pay for it. So our creditors have all these dollars that there's no need for because there's nothing to spend them on. And so they would generally depress the exchange rate. But of course, the dollar being the reserve currency for now, we don't see the reaction that a normal country would be punished for such horrific trade data, although no other country has such horrific trade data as the United States, because when a country operates such a bad current trade imbalance for year after year, the markets punish that currency and restrict the ability of its citizens to continue consuming beyond their means, and they force some sense of balance. But the United States has been spared the discipline of the market by virtue of the dollar being the reserve currency. And so our trade imbalances get bigger and bigger and bigger. And so the economy continues to hollow out and we get in worse and worse shape. And so ultimately we are going to be in store for a massive crisis. Gold market, gold up about $8 to $10. I mean, still just below $1,200 an ounce. I mean, it's really banging up and down. Every time it gets above $1,200, they seem to smash it back down. But of course, whenever they smash it back down, the buyers show up. So they really can't break the market, but there's still been enough overhead resistance to keep it from exploding. But I think eventually the buying is going to overwhelm the selling, and we will run out of sellers in the gold market. And when it finally goes up, it's going to go up in a rather spectacular way. And again, meanwhile, the dollar has turned. We're getting very strong days in the commodity currencies. The Aussie dollar up about 1.25%. The Canadian dollar up maybe 0.5%. Euro up 0.33%. Swiss franc almost up 1 full percent on the day for the Swiss franc. So, and this is, again, I'm doing this early in the morning with the Dow off about 87 points. Bad news not necessarily being good news for the market, although there was some good news. We got one data point this afternoon that beat estimates. I think it's interesting how, the media reacts as soon as there's one good data point. They don't care about all the bad ones because almost all the news is negative. But every once in a while, you get a kernel of good news and the media jumps all over that. Aha, you see, this proves the economy is strong. We did get the April ISM service non-manufacturing index unexpectedly rose to 57.8 from 56.5 in March. So that was better than estimates. But that happened despite the fact that new orders plunged into negative territory. So, there was a negative aspect of that supposedly benign report or better than expected report. I think that would be troubling to see that big drop in new orders. But also the April PMI that came out at the same time as the ISM, that actually dropped from 59.2 in March to 57.4, and that was a bigger drop than was expected. So again, if April is supposed to be the spring when things get better, why is the data getting worse than in March? And remember, the data wasn't that great in the first quarter because we got only 0.2% GDP growth, which of course is going to be revised negative based on all the bad data that has come out since they made that guesstimate. And of course, the worst being the horrific trade numbers that came out today that are so far above what the government would have used to calculate that number. And again, the biggest joke of all is claiming that the cost of living went down, where you have an inflator instead of a deflator. So a lot of things came together in order to get a positive GDP momentarily in Q1, but I think we're going to revise that away. The big question is going to be, what is going to happen for the Q2 number? All eyes on that. All eyes, of course, are going to be on the non-farm payrolls number. That is going to come out on Friday. And these numbers, up until last month, last month was the first time in a while that we got a bad payrolls number, right? That number came out at 126,000. They were looking for a number similar to the number they're looking for this time, which is 220,000. And of course, the estimate is from as low as 180,000 to as high as 335,000. That's how much optimism there is on there, right? Nobody is looking for the April number to be lower than the March number. The only question is, how much higher is it going to be? And you have some people that think it's going to be as high as 335,000 new jobs created. Again, the consensus is 220,000. So we're going to see the consensus is also for the unemployment rate to keep falling from 5.5% in the prior month, March, down to 5.4%, heading towards that 5% level that the Federal Reserve claims we're headed for. But this is going to be a big number because if we miss again, then I think the dollar's going to get crushed. Now, I don't know. This number has been very surprising and confounding over the months for how many numbers we got above 200,000. And the reason for that, and I pointed this out many, many times, is because all of the part-time jobs just skew the whole thing. Because a job's a job, right? So if you get a job and you work 1 hour a week, that job is part of the 200,000 jobs that are created. And so if somebody loses a 40-hour job, right, and then two people get jobs where they work part-time, that's a net gain of one job, right? And so, the hours work or the average hourly earnings, you'll tend to pick it up in there. But as far as the raw number of jobs, right, that's all they're counting. How many jobs, not quality, right, not pay, just the number. And the net number, because obviously some jobs are lost and some jobs are created. But the problem is the jobs that are lost are better quality than the jobs that are created. And so that's what has been skewing it. But I still, based on all of the other weak data that has been coming out, my guess is that we'll have a weak report. But again, I've thought we'd have a weak report before and have been surprised by the fact that they keep coming up with a strong report. But of course, at some point, people are going to have to realize that these strong data points don't matter, that just creating a part-time economy doesn't cut it. Just because a lot of people have low-paying part-time jobs. In fact, that's one of the reasons people are so they don't understand, they're scratching their heads and they're trying to figure out, we have all these jobs, but why aren't the consumers spending, right? Why are retail sales weak? Why are auto sales coming down? Why are home sales? Why is the percentage of first-time home buyers at record lows? Why now do 25% of all renters have to spend half their income on their housing costs? We have all these jobs. Why is the economy getting worse? Why don't we see the benefit of all this employment in these other statistics? And the answer to that question is because the jobs don't pay very much, either because they're just low paying or the workers don't work that many hours, and so they don't net end up with a lot of money. Meanwhile, as much as the Fed wants to pretend that there's no inflation, the cost of living is rising, and it's rising for everything. The only benefit we had recently is that there was one significant cost that was going down, and that was fuel, gasoline, heating oil, things like that. And now that's changed. Now that price is going up. So the one thing that the consumer had to fall back on, right, now it's gone. That rug's been pulled out from under them. Safety net, gone. Attention listeners, I have an urgent message for you. We're in the middle of a war. The global conflict is destroying the lives of millions without a single bomb being dropped. It's called the International Currency War, and your bank account has been drafted to fight. The victims in this conflict are our currencies, the dollar, the euro, the yen, the pound. They are all heading to zero as irresponsible central banks compete to see who can print the most the fastest. But there's one form of money politicians and central banks can't destroy: gold. Today, it's more important than ever to understand the value of gold in your portfolio and to keep a close eye on major market developments. Subscribe to my monthly videocast and you'll be the first to hear my latest analysis on gold investing and the currency wars. Visit goldvideocast.com right now to subscribe for free. I call the dot-com bust, then the housing bust, and I advise clients to diversify into foreign equities and hard assets while the rest of Wall Street laughed at me. Now I want to keep you up to date on the next crisis that is brewing. My Gold Videocast also includes personal interviews I've conducted with other contrarian investors like Jim Rickards and Axel Merck. Gold has gone up 256% since 2003, but it has a lot further to go. Don't miss the rally. You can prosper during this time of currency wars, but only if you stay educated. Get a free subscription to my Gold Videocast at goldvideocast.com. That's goldvideocast.com.